Hey Amanda, thanks for coming back on the show.
Yeah, thanks for having me, Peter. Excited to be here.
Yeah. How are you? How have you been? I know it's been 6 or 7 months since we had you on before.
Yeah, been good. It's just the holidays is always a busy time, and now before you know it, it's tax season again. It's sort of the inevitable for everyone, every year to kind of head into tax season. But things been good, and there's been a lot of potential changes coming up in the tax world. So I'm excited to be here to kind of chat through some of those possible changes with you.
Yeah, I know. We talked a lot about bonus depreciation and everything. Let's kick it just with a potential good news. I know that there's a bill that they want to go back to, or some of the people in the legislation want to go back to 100% of um, for cost sake and bonus depreciation. So talk a little bit about that.
Yeah, back in 2023, or I guess back in 2022, we had what's called 100% bonus depreciation. It was very beneficial for both real estate investors and just business owners, because certain assets that we use for business purposes, instead of depreciating it over 5 years or 7 years or 15 years, we got to write off up to 100% of that immediately. And what happened was the current law or the original law is that the amount of bonus depreciation started decreasing. So 2022 was 100%. 2023 we were able to bonus depreciate 80%, and then 2024 currently it's at 60%. And so again, very powerful tool for those who own real estate or own businesses because we got to kind of front load a lot more of that depreciation. So the exciting part of this whole thing is currently there's a bill that's moving through Congress, already passed the House. Waiting for the Senate, and then obviously the president will still have to sign it. But the proposal in its current format is looking to bring back 100% bonus depreciation to 2024 and also for next year into 2025. So for this year, literally it will be, instead of taking 60% bonus depreciation, we might be able to do 100. And what's also super exciting about that is, in a rare move, they're looking to also bring that back retroactive to 2023. So for, if you had 1099 income or you own rental properties that you bought last year, it would potentially be a really huge windfall in terms of how much taxes or how big of a refund you get for this coming
Okay.
April.
So I got a question about that. When is that supposed to be approved or denied? Is there? Do you
That's a
know
good
the?
question. Yeah,
Because
that's a
you're
good question. When is this going to happen, right?
yeah,
And we don't know. And
yeah.
I, of all people, really want to know because we're already in the middle of tax season. We're preparing tax returns for small investors, for syndications, and that's kind of everyone's question. Unfortunately, as we all know, right, Congress does not move fast. So
No.
there's really no insight into when it will pass or actually whether it will pass. Like, there's always negotiations that go on behind the doors that you and I don't know about.
Yeah.
So what we're telling clients though is that we're still going to prepare tax returns, right? So if you have all your information, send it to your CPA. Let them start preparing the return based on current law.
Hmm.
And the only difference is don't file it yet. Don't submit your returns yet, because we want to give it a couple more weeks. Maybe it'll pass in a few weeks. And if they do, then we could just change that one number. We just change that calculation of bonus depreciation back to 100%, and then
Okay.
you'll be able to submit your returns pretty quickly.
Okay. So question for you on that: what if, let's say, someone's listening to this and they already submitted? Do they have to go through an amendment process, and how long does that typically take?
That's a great question in terms of, what you've already submitted. Now, we also have clients who just want to submit. They want to get a loan, right? And to get a loan, you need to have your tax return. So, what the IRS had come out in the last couple of days is they said, don't wait, go ahead and file your tax returns. And if we do make this change and give you 100% bonus depreciation again, we will recalculate your taxes and kind of give you the difference. So that sounds really amazing. Less work to do tax return filing. However, my personal opinion is I don't trust the IRS to recalculate any of my taxes. So hence our suggestion is wait to file. And if you have to, yes, I highly recommend you consider an amended return. So you're kind of more in control of how that's calculated and you know the accuracy of it.
Got it. Okay. All right. Yeah, that's good to cover for the people that maybe already submitted. Because I know last year, due to the weather, we were able to submit not till October, and now for California at least, and then now it's back to normal time, April.
Yeah, well,
Okay.
actually, for everybody, we can file extensions.
Yeah.
So, whether you're an individual or entity, so if you have an entity tax return, you can always get an automatic extension from March to September. And for individual tax returns, we can always extend from April to October. So, yeah, that's still available to us. And we do have a lot of clients who extend anyway, just from a planning perspective. That is an option. The one caveat I would say is just to remind everybody that the IRS allows us extension of time to file our tax returns, but not additional time to pay. So if you're expecting a refund, fine, you can extend, no issues. Just have your CPA fill out a one-page form. Again, it's automatic. So as you file it, they'll say, sure, you're approved for the extension. But if you owe taxes, you had a great year, you think you're going to owe taxes, you do want to work with your CPA to calculate an estimate of what you think you'll owe, because then they'll be able to, have you make that payment by April 15th so you don't get penalized for paying that dollar amount late.
Got it. Okay. Okay, cool. And talk to me a little bit about, what's the strategy, business wise or personal wise, outside of obviously May owing, for people to wait till or file an extension? Is there other reasons why someone would do that?
Yeah, I mean, there's several reasons as to why people might go on extension. One will be just giving you additional time to gather your documents, right? I mean, in a perfect world, we all have our books ready and it's ready to go. But the reality is, especially for smaller business owners, real estate investors, is sometimes you're playing catch up to try
Hmm.
to make sure you capture all your expenses. So that time does allow you more time to get organized if you need it. The other, I think, from a planning perspective, that's really beneficial as to why go on extension is extension gives us more insight into the current year. And what I mean by that is, right now we kind of project what we think we'll make for 2024, but we don't really know for certain. But maybe by August or September or October, I have a pretty good idea what 2024 looks like. And so it could give me an opportunity to say, well, how should I file my 2023 return so I get the optimal tax savings across both years? We were just talking about bonus depreciation. So, one example could be if my income was average in 2023, this year my income is going to go way up, right? I'll know this in October, this year's income's way up. Well, maybe I'll wait to do my bonus depreciation until 2024 when I'm saving taxes at a much higher tax rate
Yeah.
than if I would have done otherwise. So it just gives us that insight into multi-year tax planning.
Gotcha. Okay, that makes sense. That's good insight, especially if someone's listening to this and hasn't ever filed an extension on why they should.
Yeah,
So
and I think especially for people who are, I mean, for landlords, our income is pretty, hopefully it's pretty consistent year to year. You know how much rental income you're going to get. You have the recurring expenses, um, but especially for our clients who are realtors, mortgage lenders, our income can fluctuate quite a bit between year to year, and that's where that multi-year planning could come in really handy.
yeah, true. And then let's shift to. I know you don't have to have this. We did, we covered this last episode, but you don't have to be a real estate professional to do that cost segregation. But if you are someone that's in a profession that could ultimately capture that as a better tax savings, can you go over that? Just a brief overview.
Yeah, certainly. So, one of the benefits we talked about for real estate investing is the whole concept of depreciation, where we get to write off the paper loss. And so, in addition to that, the supersized version was the bonus depreciation, right? Whether it's 40% or 60% or 100%, nonetheless, it's a pretty big loss. And so, what we typically see is for those who own rental real estate, even though you might have really good cash flow, for tax purposes, you're often faced with a tax loss just because of this paper write-off we get. And then the question for most people becomes, well, what happens with that loss? If I had a tax loss of $50,000 on my rentals, what type of income can I offset with that rental loss? And this is where real estate professional comes in, because if you are higher income, and usually that's defined as somebody who makes over $150,000. So if you have higher income, your rental losses only offset taxes from rental income or other passive income. So like other rentals, other investments you have. But it doesn't offset your W-2 income or your mortgage broker income. Um, because there are different types of income when it comes to taxes. And so the
Okay.
loophole around that is if you or your spouse is a real estate professional. So in other words, if you're a real estate professional or your spouse is, then you can use rental losses to offset all types of income. We're no longer limited to just offsetting rental or passive income.
Gotcha. Okay. Awesome. That's good, especially for like you said, mortgage brokers, real estate agents, to offset that. Okay. So what we didn't cover last time, and what I want to definitely cover this time, is an overview on doing self-directed. I know you're not a custodian, but you deal with a lot of this with professionals that you work with on tax advising and strategy. So if I came to you and I said, "Hey, I'm looking to get into taking some of my money and move it over to, self-directed," walk me through some, kind of do's and don'ts on the tax side of what I should be looking for.
Yeah, I think it's really interesting because, we've always been able to use retirement money, like IRAs and 401ks. We've always been able to use that for other assets, including real estate. But it's just a topic that not a lot of people talk about. Because I think in the media, you always hear about, people who are investing in the Schwab or Fidelity and use that in the stock market.
Hmm.
So it's really, really important to understand that this is not like a loophole. It's not something new. It's just been around forever. We've always been able to do it. I think now we're finally getting more awareness into the possibility of using retirement money for real estate. And it's actually pretty simple. I think a lot of times people make it harder than it needs to be. It's, all the same rules as a regular 401k or regular IRA when it comes to who can contribute, how much can you contribute into retirement. The only difference in a self-directed account is that you're not limited to the stock market. You're not limited to mutual funds. You can, in fact, invest in whatever it is that you want to. So whether it would be rental properties, or you want to use your IRA money to be a hard money lender to a friend who's doing a fix and flip. Those are all possible asset classes that you can use that money for. And so this is a really big area that we work with clients on when it comes to planning, because most of our clients are real estate investors. And so for us, the question is just, hey, if you had 50,000 or 100,000, how much income do you think you can generate in rentals or notes versus how much historically have you been generating in the stock market? And that's really how you decide whether you want to do self-directed or you want to just leave it, in the market.
Gotcha. Okay. And then are there any requirements on how much, or at least caps on how much you can contribute to that type of retirement?
Yeah, I mean, the contribution limitations is the same as any other IRA or 401k, right? So this year, I think it's a little bit over 6,000 that we can put in for the IRA and Roth IRA. And then for the 401k amounts, a little over 22,000. For the 401k, you have the employee bucket and the employer bucket, just the same as when you have a regular job. And also really important to understand is for those of you who have a 401k, let's say you had a job that what you were contributing to previously, and now you've left that job, you can actually roll all that money over into a self-directed account, and there's no annual limitations on that. So if I used to work at Apple and I've built up $500,000 in my 401k, now I can roll all of that money into a self-directed account and buy a couple of rental properties. So there's no cap in terms of how much you can roll over. And in fact, we're seeing more and more clients where even their current employer is allowing rollover. So I think Google is one example where they allow employees to roll over part of their current 401k plan into different types of custodian. So, if you're an investor and you're trying to figure out whether you can move a current employer plan over, all you have to do is ask, right? Ask your plan administrator and say, hey, does my plan prohibit me from doing a rollover while I'm still working here? And the worst case is they say no. Because the IRS allows rollovers anytime, but sometimes the employers will have restrictions. Like one employer might say, oh, you can roll over only what you've vested, or you can only roll over once you're a certain age. So we just want to know what is the specific plan rules for your employer, and you can plan accordingly on that.
Gotcha. Okay. Um, and then so for looking at when you ultimately have that type of account and you have 5 properties, and that solo 401k, can you call yourself a real estate professional at that point or no? So
Yeah, great question. So one thing that's really important to understand is all the traditional strategies we talk about with respect to being a real estate investor. For example, depreciation, real estate professional, where it offsets your W 2 income, or even just writing off, maximizing your expenses, like a home office, or using your car for business. All of those are a separate topic when it comes to self-directed accounts. The easiest way to think about it is you are a taxpayer and your IRA is a different taxpayer. So
got
when
it.
your IRA invests in rental properties, you are not going to pay taxes right now on the cash flow, right? Because it's in the retirement account. And so conversely, if the IRA has expenses like depreciation and stuff, it's not going to offset your personal income taxes. It's going to offset any taxes, if there were any, within the retirement account itself. So to answer your question, no, I mean, you wouldn't be a real estate professional and use depreciation personally on the rentals owned within your retirement account, because they're almost like two different taxpayers.
Got it. That makes sense. All right. So you mentioned something about writing off like cars and stuff like that for business. What are, I would say 3 to 5 things that you should be writing off in your business, and we can kind of break
Mhm.
those down into smaller chunks. But overview, what are like 5 things that people should be writing off if they're not doing it now?
Gosh, there's so many. I think it's so hard to pin it down to five, but I would say, especially now that we're heading into tax season, one of the things I always encourage our clients to do is when they're spending money on something, if it's a recurring dollar amount, if it's a significant dollar amount, ask yourself this question, is this something that is ordinary and necessary for my business? My business as an investor, my business as a realtor, my business as a lender. And the answer to that question will differ for each person, right? Even if you and I are both realtors, we might have different ordinary and necessary expenses. But that's a really good habit to get into, is to ask yourself that question. And if the answer is yes, then they'll definitely keep a copy of the receipt, track those expenses. If the answer is unsure, that's what your tax advisor is there for, right? So you call or email them before you spend that money and say, hey, how can this potentially be a tax deductible item for me? Because then you can brainstorm, well, okay, maybe generally it's not, but what are some of the things that we can change the facts so it becomes a legitimate business deduction? And I'll use travel as an example. If you're going somewhere, let's say you're going to Orlando with the kids, and it's like, well, it's a personal expense. There's really no write off for it. But what if you planned ahead and you said, well, in addition to going to Disney World, I'm also going to attend a couple of real estate conferences, right, that happen to be in that general area or even an hour away. And so if you plan ahead and you have some legitimate business purposes as to the trip, well, now you're turning at least part of the flight cost or the hotel cost into legitimate business deductions.
Okay, cool. And then I think a couple years ago there was certain things that they took off the plate of being able to write off. Maybe, and I'm just thinking about it right now when you were talking about this, but maybe meals. Was there a certain amount that you could write off on meals, and then that dropped a little bit? Is that something that's changed?
So yeah, two changes that are notable. So meals was always at 50%. So if you've spent $100 taking clients out to meals, taking an investor out to meal, they always previously only allowed you to write off 50% of it.
Mhm.
I think the assumption is the other 50% was like you needed nutrients. So there's some personal nature to you obviously eating.
Yeah.
Um, Back in during the period of COVID, they actually increased it to 100%, because that
Okay.
was when restaurants were closing and they really wanted to incentivize people to, go eat.
Yeah.
So they actually brought it up to 100%. Now, currently, 2023, 2024, it's back down to 50%. So
Okay.
something important to understand. I always suggest for my clients, you track 100% of your expenses and let your tax person, when they do the return, to do the right haircut. Because if you're already tracking 50% and they didn't know, they might do another 50%. Now you're only writing off 25%.
Yeah.
Another like sort of a major change related to that area is entertainment. So we used to be able
Okay.
to write off entertainment expenses, and in the last few years, in the current law, is that entertainment expenses, even though business related, are no longer tax deductible. Which is terrible, especially I know for
Yeah.
people in real estate, because there's a lot of entertaining you do with investors, with clients. So one tip is to clearly split out the costs you're incurring for entertainment versus meals, because we all know when you entertain, there are a lot of food related costs. So
Yes.
if you have a clear way of differentiating, if you go to like take someone to a sporting event, for example, the ticket itself is entertainment, not deductible, even though business related, but the meal, if you're feeding your clients, those are still deductible as long as you can clearly separate the two.
That's a good idea, and that's good you covered that because that's something that people may combine together. They bought the ticket, and then maybe some ticket included some type of meal, but it was in that $600. But if you take it
Yep.
out, you're probably spending the same amount unless it's like a package thing, and you can ultimately save the money or at least write it off, right? That's a good
Yeah,
tip.
yeah, for sure.
Okay, so I come to you as a person that's going to walk through all my stuff strategy wise with you. And I have a bookkeeper. Typically, does your firm do bookkeeping or is that something that's outsourced from that person and then they bring you the or not the Excel file, but the QuickBooks file and then you guys go through it? Walk me through that process.
Yeah, I mean, we have clients who do, all of the above. We have clients who are just smaller investors and they do their own books because
Okay.
it's pretty simple. They got, 2, 3 rental properties. And then we have clients who are, kind of in the middle range where they have a handful of properties, or they just don't like software, they don't want to deal with it, where we'll do their bookkeeping. That's always great, right? Because it's streamlined. We already know the numbers, tax time. We just pull everything. And then I think what we typically see is as clients scale, they get to a point where they actually need their own bookkeeper, whether it's in-house or someone that's more full-time. So that works as well. What we typically do is we help them to select or train that bookkeeper so they understand like how to do it in the optimal way from a tax perspective. People always ask me like, what kind of software do you like? What kind of method? Is it Excel? Do you like software? And my response is, it doesn't matter what I like. What matters is what you like or your bookkeeper likes. Because at the end of the day, you or your bookkeeper is going to be the one doing that daily data entry, weekly or daily data entry. And so it just needs to be a system that works well for you. So I love QuickBooks, but if you don't like software, what's going to happen is you're going to buy QuickBooks and you're not going to use it. And a year later, you're going to be really stressed, like, wow, I never did books because I was afraid to open QuickBooks.
Yeah, I mean that's for me. Like I did my own books for the first couple of years, and then I said I got to outsource this because one, I'm not good at it, and I hate it, and two, if you're willing to spend that money to have that person, the bookkeeper or whatever, do that, that's very beneficial. Because for one, they're going to look over it way more than you are. Are there things that people not do wrong, but miss when you get QuickBooks? Is there a specific way to kind of intake that stuff that you could think of that would save you and your team time throughout the process of getting the books?
Yeah, I think, if we're talking about rental real estate specifically, it's really important to understand or at least set it up so that you are tracking your profit and loss on a property by property basis. For one thing, it's required for tax purposes. IRS requires you to report income and expenses by property.
Okay.
And then the second reason is, you want that as an investor, right? You want to know how are my properties doing against each other, right? Or as a standalone, how is it doing? And having timely financials, timely meaning like every month I know where my numbers stand is really huge. Because if you're not looking at your financials until a year later, then it's possible that you've overspent on things, utilities, water leak that you don't even know about. until it's way too late. So as a business owner, I think it's really important to stay on top of that. I think one mistake for those who have bookkeepers is not reviewing the financials. I think we tend to think, well, my bookkeeper's taking care of it, so I'm assuming it's correct. But I always tell clients, hey, at least do a high level overview, right? You don't have to look into every transaction, but at least print the profit and loss and say, hey, what is this report showing me in terms of profit? If I'm in my head, I'm thinking I made $40,000, but when I print the report, it shows actually I made 30,000 or 20,000, then maybe I want to look into it or have a conversation with the bookkeeper to kind of dig into why there's such a big difference between what I think I'm making versus what the paperwork actually shows.
Yeah, I think that, you hit the nail on the head at least with, sending your stuff to a bookkeeper. There's ways that and times that people can definitely be lackadaisical and not, review that stuff and then realize either their expenses are too high. I mean, maybe this is something that you've talked about or gone over with your clients, but what I usually do is once I hit the first of the year, I'll print out the last few statements on my own and not look at the QuickBooks, but go through with a highlighter and say, okay, hey, this is an expense that I don't need or I do need, because I think that there's an app out there now. I've seen a couple of commercials about it, but it will go through and show you like stuff that actually you're paying for, you shouldn't be paying for. But go through with a highlighter and see what you're paying for and what honestly you forgot about and what you're not using anymore to eliminate those expenses so you can net more money.
Yeah, I love that tip. And I would have to say, most people don't do that, right? Most people don't know. And a lot of these like subscription stuff that you pay for, and because, they're all like automatically charged, your
Yeah.
bookkeeper's automatically entering it. And so we don't even remember until years go by. So definitely a really good tip to, look through. And I think clients ask me that all the time. Like before we start on a tax return, we'll always ask the client, like, hey, have you looked at your financials? Do you approve those financials? And sometimes people will say, I don't know. I don't even know what I'm looking at. And that's
Yeah.
when we say, well, let's have a call so we can look at it together and we can tell you what exactly it is you're looking at, right? You don't want to just trust it up to somebody else and be like, yeah, that I don't know. So I think it's correct.
Yeah, yeah, and I mean, that's where, the trust can only go so far because that bookkeeper may have, 60 other clients that they work with a month and they're not going through with a fine-tooth comb like you should as the business owner because they're not looking at it as much as you are or should be looking at it as much as you are because that's your income. Um, okay, so if I'm a business owner, let's say I'm an agent, I'm a investor, is there a certain amount of profits that I should be looking for? Let's exclude, depreciation or anything like that. Is there a certain amount of profits that I'm looking for as a business owner for my business, small or big?
Really depends because every industry has different ratios, right, that you expect to have in terms of how you perform. So like,
Yes.
as a CPA firm, I think our industry average is your net is going to be 25% or 33% of gross, because for us, salary is very high, right? Or
Yes.
software is very high. And so for, whether you're a realtor or a lender, I think that differs pretty widely. I would say for most realtors, brokers, profit margin is fairly high, right? Because the cost to operate that business is much lower than a traditional, a clothing store, for example, that has to hold a lot of inventory. But I think it's really important to, kind of do something similar that you were talking about. We do this in our firm too. Is at the end of the year, we'll do a review of, okay, what happened last year? And then we'll
Yeah.
try to project out what we think the following year is going to be. And when you do that year over year, you start to notice trends, right? In terms of, and you're able to kind of predict out more what your needs are. Like, do I need to hire, somebody to work under me? Do I need to hire an admin person based on what your projected revenue is going to be?
Yeah, 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 for sure. Um, okay, so you hit something with employees. So let's say, small business and I have one employee. Are there some things that I need to look out for, not benefits wise or anything like that, but things that I need to look out for tax wise for employees?
Yeah, for sure. And I just want to define employees real quick because I do get this, I do have clients who are confused a lot.
Yeah.
So when we say employees, we mean somebody who's a W-2, like they're on payroll, they're working for you, you give them all of the equipment and everything versus 1099 contractors. So if I'm a broker, I got agents under me, I just issue them a 1099. Those are not employees for tax purposes. Whether somebody's a contractor or an employee is dependent upon what they do for you, and kind of how much control you have over what and how they do certain things. So the more control you have, the more likely it is that they're going to be an employee. So naturally speaking, if someone is a contractor, at least from a tax perspective, it's a lot more favorable to the business owner because as a contractor, they're responsible for their own payroll taxes into Social Security and Medicare and all that. You also don't have to give them benefits, right? Healthcare, 401k, all that is on their own. They're like their own little employee agreement. But when we start to have employees, and especially full-time employees on W-2, we definitely have to consider them when it comes to tax planning. Because there are a lot of rules in the tax world where you cannot exclude employees from benefits. And we talked about self-directed investing earlier. So we'll use retirement account as one example. So if I have a full-time employee, I can no longer just, open up a solo K and fund everything for myself. I have to open a regular 401k because now I have an employee. I'm no longer a solo person. So I have to fund for my employee. I have to consider, how much they make and how much, if I'm giving myself 20% employer contribution, I have to do the same for my full-time employee. So there's always a cost benefit analysis that we have to look at when you have employees and we're thinking about planning for taxes.
Gotcha. Okay. And so are you able to do a SEP as well, or is that not included if you have a full-time employee?
Yeah, you can still do SEP. So we have clients who do SEP IRAs when they have employees, but keep in mind it's still the same rules. So if the business is contributing into the SEP, that for you, then they also have to do it for your full-time employees too. And if you think about it, these rules are all in place because otherwise you could be working for Google or Toyota and they might not ever fund, right, for the employees. And so it's just the government's way of equalizing the field so that they're saying, hey, if you're an employer, you get benefits, your full-time employees also have to get comparable benefits.
Gotcha. Okay, that makes sense. And is there anything for you as an employer when you have employees that are full time, that you can ultimately write off? For instance, if there's uniforms or anything else that you have on the expense sheet. So, is there anything, maybe a couple that I should be looking out for if I do have a full time employee?
Yeah, for sure. I mean, anything that you provide your employees in order for them to do their job would be deductible, right? So going back again to, is this something ordinary and necessary for my business? So if I'm buying uniforms or logoed clothing for my employees, obviously they're deductible. I send my employees to go to conferences, education, pay for them to travel to places. I'm going to pay for them to meet with clients or investors. Those are all business deductions. So it's no longer just limited to you and your expenses. It's going to be for the team, right? What are all the things that the team has to do for the business? And one of the strategies we work with clients on is having your kids become one of your employees. If you have older kids who can help out, whether it is helping out at an open house, helping you with your turnovers, if you own some short-term rentals or long-term rentals, the money you pay them is a deduction, just like if you paid anybody else to do those same things. If you have to give them the tools, you have to buy your kids a laptop so that they can help you with your bookkeeping, data entry stuff, right? Those are all business expenses, just the same as if you hired me to do your books and you got me a laptop for that specific purpose.
Gotcha. Okay. And then, so we're talking a lot about investing in real estate. I'm a business owner and I buy, a building to have my business in. Talk to me about that on write-offs. Is that a different structure for a business owner versus, me owning a rental property down the street from my house?
Yeah, I mean, one of the biggest opportunities as a business owner is to be able to actually own the real estate where you operate your business, right? So instead of just paying someone else rent, consider, what if I bought the building I'm in, or I buy a building that I'll move into, so that I have an appreciating asset. I have a built-in tenant, which is me and my business. So absolutely, that's a great strategy just from a business and investment perspective. From a tax perspective, it's also amazing as well because if I have a property where I am the tenant. In the tax rule, we call that self-rental. So if I have a property in where I'm utilizing, then what you can do is you can group the rental property activities with your business for tax purposes, and then be able to use the depreciation from the real estate to offset the income from that business operation. And this is true regardless of whether you or your spouse is a real estate professional or not. So it's a very, very powerful tool. Now, having said that, the one thing I do want to just kind of throw in there is we typically don't recommend the same entity own the business and the real estate. We
Okay.
typically like for them to be in two different entities. So you'll have an entity that owns your business, right? Maybe like an S corp or a C corp, and then separately you have an LLC that owns the rental property, and you'll just rent. It'll lease to the LLC will lease the building to the business, and that's for asset protection purposes and as well as for tax benefits to keep them separated.
Yeah, because obviously, well, so that's I haven't heard of that, but that's a valid point. Obviously, if you're living in your house, you want in your name or in a trust, if it's your primary residence, obviously it's a rental. We could talk about that tax structure, but because then you could void out that 250,000 or $500,000 tax savings. But for a business owner, you own a building and you're running a real estate office or a lending office. You can or you should put that building in an LLC or some type of structure, and then also have your business in a completely separate entity.
Yeah, yeah, for sure. And we just, it's always just cleaner that way. Because again, typically your active business will usually be in some sort of a corporation to minimize taxes on that end. And conversely, we typically don't want rental real estate in a corporation. So tax wise, we have competing interests. And that's the reason typically they're going to be two different entities and different types of entities.
Gotcha. Okay. And does it change on depreciation of the building? So if you're depreciating it 39 years, I think for commercial, right? 39 years. If you own it in an LLC and you're renting it back, is it still 39 years?
Yeah, it
Okay.
is. And so, yeah, what a lot of people don't know. So when it comes to depreciation, residential real estate is usually over 27 and a half years, and then commercial real estate is usually over 39 years. So commercial would just be, again, anything that a business occupies. Residential could be a single family, a fourplex, or even a 100 unit apartment. Those are still considered residential when it comes to depreciation. I know people confuse that a lot because a 100 unit apartment building, you're getting a commercial loan on it, but it doesn't mean it becomes commercial property for tax purposes. It's still residential.
Got it. Okay, that makes sense. That's good to know. And then for for that, when you look to ultimately rent that property out, is there a different structure? Let's say it's a 5 unit strip mall, and yours is a liquor store or something like that in that building. Is the
Mm.
tax structure different if you own that in the LLC and then have different people paying you, or is it still all the same?
I mean, generally speaking, it's going to be the same, right? I mean, for you as the landlord, it's all just going to be rental income. So we don't really care if it's rental income from a liquor store or liquor income from a clothing store. It's all going to be the same for tax purposes. We do have clients who invest in mixed use properties where, like, okay, the first floor is going to be commercial, all the way on, and then the floors two, three, and four are all going to be residential. So that does get a little bit more complicated on the tax side. again, nothing you have to worry about as an investor, but on the tax perspective, we typically do some kind of allocation to see, okay, do we treat it as two different, two different depreciable assets, or we just say, hey, most of this is residential, we'll treat the whole thing as residential. So there's different ways to kind of slice and dice it, but at the end of the day, whichever methodology you arrive at does have to be reasonable, right? There has to be a reasonable allocation in terms of how did you arrive at this specific decision.
Okay. All right. And then are there anything that outside of the legislation that we talked about that you see or have heard about in this year now, or that changed at the tail end of last year for tax purposes?
I think bonus depreciation is sort of the big one for business owners. We talk a lot about bonus depreciation with respect to rental real estate because, building depreciation is one of the biggest things. But just a reminder that bonus depreciation also applies to businesses too. So if you bought a business vehicle, that's likely eligible for bonus depreciation, it could really change how much taxes you pay for 2023 and also going forward. All types of business equipments, not just cars, but if you bought a new computer, a new laptop, cell phone, all that kind of stuff, potentially eligible for bonus depreciation. For real estate, there's always talks of taking away 1031 exchange or limiting 1031 exchange to some aspect. There hasn't been too much talk at the moment, but
Yeah.
I feel like every election year that comes back. So I
Yeah.
expect we'll hear a little bit more about that in the coming months.
Okay. Okay, cool. And Amanda, so I asked you a couple of the normal questions last time. What's a tool or resource that you're using today making your guys' business more efficient?
Oh man, that's a loaded question. I have to say ChatGPT.
Okay. Yeah.
I don't know if everybody says the same thing. But yeah, I mean we use it quite a bit, not for taxes because it's still pretty weak when it comes to taxes, using very outdated information. And taxes are changing, every day. And by the
Yeah.
time this podcast comes out, it might have changed.
Yeah.
But we do use it a lot for marketing or just emails. It's really good at helping us to like summarize or better ways of saying certain things. So we found that to be pretty helpful. And we're, trying to encourage the team to get used to using it more and more.
Yeah, yeah, yeah. I've used it a lot for like SOPs for the business and stuff like that. And I'll use like Loom, record it, and then put it into ChatGPT, the transcript, and I'll then rewrite it in an
Oh,
SOP.
love that.
So
Love
it's
that. Love that. I'm
I
gonna try it.
yeah, I can't take credit for that, but I do. Well, so there's some guy that told me that like 3 months ago. So I basically revamped all my SOPs like that, and it's really helped out. So I got a video, and then also the transcript, which is turned into the SOP that ChatGPT does.
Wow. Very good. I'm gonna do that immediately.
It's really good. Yeah, like I used to do. I used to hate doing SOPs. I dreaded it because I got to type it out. But if you're just talking, going through it, and then it will ultimately put it into bullet point form, and then put it into an SOP, which is really nice. So,
Yeah.
um, okay, and then people, if they want to reach out to you and your firm, how can they do that?
Yeah, so my firm is called Keystone CPA. And so if any of the stuff that we talked about today was kind of newer to you, you want to know more about real estate professional status or how do I pay my kids and get a write-off, we have a free tax savings toolkit that you can download anytime from our website at keystonecpa.com. And if you're looking for daily tax tips, I am mostly found on Instagram as Amanda Han CPA.
Okay, perfect, perfect. Amanda, I appreciate it again, you coming on and giving all this knowledge, especially for people that are trying to navigate the taxes and see if they can save a little bit more here and there each year. So I appreciate you coming on.
Yeah, thanks for having me.
Talk soon.